The trade war is back with a vengeance. Also, what are the leading indicators of an upcoming recession just flashed? And we're coming off the worst week in the markets in 2019. Keep watching as we go more in depth on all of these stories.
As Matt just mentioned in the beginning, U.S. stocks just had their worst week in all of 2019. As the S&P 500 was down just under 2.2, the Dow Jones was down a little over 2.1, the Russell 2000 was down 2.5, and the NASDAQ was down the most, down over 3% for the week. Foreign and emerging market stocks were also down significantly last week, with foreign market stocks down about 2.5%, while emerging markets were down over 5% for the week and are now only up 7.5% for the year. We want to go over three separate charts of the U.S. markets today. First, the NASDAQ, then the Dow Jones, and lastly, the S&P 500. And I'd like to go over all three of these because there are some concerning chart patterns with each one of these indexes. First off is the NASDAQ, and if you're looking at the chart, you'll see the blue line right across the middle, which is a resistance level. Now, at the end of April 2019, the NASDAQ broke out above that level and made all-time highs. But from May until now, all we've seen is selling out of the NASDAQ. So this potential false breakout could be a bearish signal for the NASDAQ moving forward. The next chart we're looking at here is of the Dow Jones. And this is a similar looking chart to the NASDAQ, except the Dow Jones never broke out above that resistance level to make those all-time highs. So in this chart, if you're looking to the far right, the beginning of May, the Dow Jones got rejected at the blue line and has continuously just been falling throughout May. The last chart we're looking at here is the S&P 500. And we want to go back a little bit further on the S&P 500 as this chart starts on January 1st of 2018. Now you'll see the blue line, and again, that's a resistance level that was put in, a long-term resistance level on the S&P 500 going back to January of last year. And towards the middle of the chart, you'll see that the S&P 500 broke out above that blue line in September of 2018. And then again, a few weeks ago, towards the end of April, the S&P 500 broke out above that line again to make new all-time highs. Now, unfortunately, after the S&P 500 made those all-time highs, immediately started to sell off down below that blue line again. And if you go back to the spike in September of 2018, when the S&P 500 broke out above that resistance level, it was immediately followed by the fourth quarter of last year, which was the big market sell-off. And now I'm not saying that's what's going to happen again, but it's something that we're keeping a close eye on. And lastly, I wanted to note that if you look at the levels of the S&P 500 from January 1st of last year until current, which is about May 10th of this year, the S&P 500 is only up about 3%. So we've seen a lot of volatility in the S&P 500 without much return.
On Friday, as expected, the United States raised tariffs to 25% on $200 billion worth of imports from China. Now, President Trump also said that he is in favor of raising tariffs of 25% on an additional $350 billion worth of imports. Now, early Monday, China fired back with their own tariffs. They are implementing 25% tariffs on $60 billion worth of goods starting on June 1st. They also mentioned that they may start to look at not buying agricultural and energy products from the United States. And their foreign minister came out and said that they will not succumb to any foreign pressure. Now, also, business leaders attacked President Trump over the weekend, saying that he's going to be hurting U.S. businesses. And President Trump responded simply by saying, if you want to avoid the tariffs, make your products in the United States. And lastly, I think it's pretty safe to assume that neither one of these sides are going to be backing down anytime soon. A couple months ago when the yield curve inverted, meaning that the 2-year yield was higher than the 10-year yield, both Jerome Powell of the Federal Reserve and Larry Kudlow, the chief economic advisor to President Trump, went on record saying not to worry about the 2-year and 10-year inverting. But they said if you ever see the 3-month yield higher than the 10-year yield, that's when you should start to be concerned. Well, guess what happened last week? The 3-month Treasury bill yield jumped higher than the 10-year Treasury bond rate, meaning that you could get more interest putting your money away for 3 months than locking it away for 10 years. They also said that this was the #1 most accurate predictor of a recession coming within the next 12 months. There are a couple key economic reports that come out this week, but to be honest, they really don't matter because all eyes are going to be focused on trade negotiations.
Also, it looks like the stock market sell-off is continuing because as we're finishing up this video, it's Monday, May 13th around lunchtime. The US markets are down another 2%.
Thanks for watching, and if you're on Facebook, please like and share our video. If you're watching on YouTube, please like and subscribe to our channel.